Jason, let's jump in on the quarterly letter. A lot of volatility. The worst bond year in the last 300 or 400 years. Which one is it?
Yeah, depending on if you believe Bank of America or Deutsche Bank, we'll just split the difference and say 350 years. But it's suffice to say it's certainly the worst bond record that anybody has ever experienced that's in the market. And I think, and we're going to talk about this as we go along, but that was the really big surprise of 2022.
Yes, bonds off. They closed the year off 13. At one point, they were off as much as 17%. I think that's been my dialogue with clients when we're recapping 2022. Look, the stock market has always been volatile, and there's probably a second conversation. Look, if you were not comfortable with the S&P 500 closing off 18 or 19, probably a bigger picture conversation, because that's going to happen every 5 to 10 years, if not more often. Who knows? So now let's explain the why to 2022. Always obvious now that we get to look back, right? It wasn't obvious in June of last year that we're about to see rate hikes like we haven't seen since Jimmy Carter was president.
Yeah,
right?
I think you said that. You said it with coming into 2022. The consensus among economists and the U.S. Federal Reserve was they were going to have 25 to 50 basis point increase. Garden variety, hey, we're going to get off of zero.
Right.
And what happened was inflation was most certainly not transitory. And then you throw on the unlikely events of Russia invading the Ukraine.
Putting pressure on energy markets, specifically in Europe.
Exactly. And then that was unexpected. And then just the trajectory of inflation. There are misses where you're wrong. Like, hey, I think the score of the game is going to be 20-17, and it's 23-17. But this was like, man, the score of the game was 45-17. And the team that scored 45 was the team that we thought was going to score 17. That's essentially what happened with inflation. It just they ran away with it. And inflation got so high that it clipped a 9% year over year handle in June. And now you have a Fed trying to play catch up. And so instead of that 25 to 50 basis point increase, they increased it by 25 and then by 50 and 50. Then they had 4 straight 75 basis point increases in a row. That rate of tightening, the pace of the tightening was the quickest tightening regime since Paul Volcker, 1980, 1981.
By the way, that was in a 6-month. It wasn't like we're talking about all of 2022. This stuff doesn't start kicking in until halfway through last year, and then all of a sudden we're going at a rate we haven't seen in 40 years.
Yeah, correct. And I think that what took investors by surprise, and we write about this in the letter. Bond math, generally speaking, for the most part, works the same way on the way up as it does on the way down. For those that haven't heard me use this analogy, it's like a seesaw. As prices go up, yields go down. And for 40 years, we had that scenario where prices just kept going up and yields kept going down because the yield on the 10-year Treasury in the early 1980s was around 15-16%. So you had this long runway.
40-year bull market in bonds.
40-year bull market in bonds. Powered by declining interest rates and inflation. Inflation and interest rates were on parallel trajectories for the better part of the last 40 years, and that created this very large bond bull market, which was great, right up until the point that it wasn't. And the interest rate hikes affected the bond market more swiftly than in the equity market. And the thing that was so surprising was that high quality bonds, whether it's municipal or taxable like treasuries and agencies, those are the traditional ballast to your portfolio. When equities do decline by that 15-20%, the bonds are supposed to be there for you. In 2008, when publicly traded real estate was down 60% and international equities were down 40 and US equities were down 45, Barclays aggregate was up 5%.
Right.
It was there.
That's historically how this has played out.
Yeah, exactly. Or the new normal started in a year where there was no place to hide. And when we looked at the composition of capital markets and how they performed, whether it was traditional markets like U.S. large cap stocks, S&P down 18, small cap stocks, Russell 2000 down 20, the international outside of the U.S., the ACWI ex-U.S., which is just any equity that's publicly traded that's not U.S. based, down 16%. Publicly traded real estate down 26, high yield bonds down 11. Barclays aggregate, which is treasuries and agencies, down 13. Immunities down 8.5%.
Fair to say there was nowhere to hide because of the pressure that we saw from interest rates going up. That if it was a risk asset of any nature, it was going to take a haircut. It's just how much.
Exactly right. Even short treasuries were down
Right.
a couple percent because of the effect of the interest rates.
You hint at in the letter a regime change, right? So the trade for the last decade, for more or less, has been mega cap US, heavy technology,
Yes.
phenomenal operating leverage, asset light models that keep growing earnings. You're implying, are we at a regime change, or look, you can't just keep following that same playbook? And you make some quotes and references to that in the letter.
I think, and it's not that I think that U.S. large cap or mega cap.
We still
equities
believe
are
in
gonna be negative.
diversification, right?
Yeah,
we're not throwing that out.
So there were just a lot of things that happened, and those markets all re-rated lower. EM, international, small, and mid. Whereas you still had U.S. large caps are still trading at a premium to they were at history, and these really good companies like Google and Microsoft and Apple and Amazon, who they do wonderful things.
But there's a difference. There's the company and there's the
stock price.
You can love the company, but the stock, if it gets bid up too far, becomes a stock you don't want to own.
And it doesn't mean that those stocks even have to dramatically drop.
Right.
It could just be that the assets or these risk assets that declined in value are going to come up, right?
Mm-hmm.
So I think that there's a lot more upside, and a lot of it has to do with the strength of the U.S. dollar. And really, since the bottoming of the great financial crisis, the dollar has been on a fairly, it hasn't been a perfectly line up and to the right,
Sure.
but a fairly strong upward trend. And right around the time that inflation peaked, you started to see the signs of the dollar rolling over, and it rolled over in the fourth quarter, and it declined when you look at the dollar index, which is the dollar against a basket of other currencies. Okay, well, what did well? So if you deconstruct it starts to benefit
non-U.S.
and smaller companies, right?
Right.
Because small and medium-sized companies, for the most part, they're selling to me and to you. When you're a large cap U.S. stock and 50% of your revenue comes from outside the U.S., the strong dollar goes further when you're trying to make fixed investments and do those things. So that works really well. It's a tailwind. Well, the inverse is also true. When the dollar starts to weaken, it's less of a tailwind, becomes a little bit more of a headwind for these large multinationals, and it's a tailwind for international stocks, emerging market stocks, and small and medium-sized companies. And if you just looked at the S&P 100, which is the 100 largest publicly traded stocks, mega caps, it was up a little bit over 5% in the fourth quarter. Mid caps were up 10. Small caps were up 9. International stocks as a broad group, developed and emerging, were up 14.7%. The new normal that we see is volatility is going to continue to go up, right? We're going to have more of it, not less, as we grapple with all the knock-on effects of inflation. You're getting paid to own fixed income.
Mm-hmm.
I mean, that is like a viable
You
alternative.
haven't gotten paid to own fixed income in a decade. If we look at past rates.
Yeah. Yes. So now you're getting paid to own fixed income. So savers don't have to go out there and make more risky decisions. That's a viable alternative. And what you can't just count on being long and strong, the S&P 500, to solve all your problems, because there are a lot of dynamics, there are a lot of things that were tailwinds for the S&P 500 that might create somewhat of a headwind relative to some of these underperforming asset classes. And we believe in diversification. We've held them when they've underperformed. We've been, obviously, the single largest exposure that we have is to U.S. large cap equities. However, with that being said, where are we putting new money? We're not going to be putting new money at U.S. large cap stocks. It's going to go into the areas where we're actually seeing value, whether it's in fixed income for the first time in a decade plus, or in small and medium-sized companies domestically and international companies that we think offer really good value.
So in the new normal, when I hear you say all that, diversification still is our thought process, right? I mean, we're not so confident as to say we're going to slide all the chips into large cap value and international, right?
No, I think you need to have diversification, but in terms of the next dollar in, I think you need to be more discerning about where you put it in, and investors are already becoming discerning. I think the only time that we could be considered in a bubble, and what I consider a bubble to be, is what Cliff Asness, who's the co-founder of AQR, says, is that when you expect on a 10-year period that bonds are going to outperform stocks, that's kind of, you're in a bubble. I don't think we're there. I don't think bonds are going to outperform stocks. We believe in the long run, stocks are going to be the way that you're going to have growth. You're going to grow your portfolio over time. Fixed income is just going to have more of a traditional role where it serves as the ballast, and you're being able to generate income.
Look, we appreciate that 2022 was not an easy year to be an investor, right? You had unprecedented bond volatility in combination with the stock market. So maybe some closing thoughts for the audience on 2022, and generally speaking, our expectation that investors, disciplined investors that keep their head in periods of like 2022 historically get rewarded, and we don't think that trend is broken.
No, I don't. And I think this is where it's really important to get kind of to the blocking and tackling and the fundamentals of investing. Bonds were down double digits, and that's never fun, but they still held up better than stocks. There's rebalancing opportunities to be had where you're selling something that held up better, and we have some real asset.
Well, if you go look in the strategic income,
we have some strategic income sleeves where we have some positive performance where you can sell, right? You're going to rebalance and do some of the things that maybe you weren't as likely to do, given that stocks continued to be on this run. Now you can get back to a more standard asset allocation where you're rebalancing in and you're selling some fixed income, maybe you're selling some strategic income and moving it into these places and topping up areas that relative to the S&P still did, still.
And in the interim, your bonds, if we just use today, 3.5%, 4% doesn't seem like an unrealistic outlook for bonds.
I think that there's a lot to learn from 2022, and the way that I end the letter is just saying that what we can't do now that we're out of this is spend the next 3, 6, 9, 12 months trying to fight the last war. I think what we're trying to do on the investment side and on the advisor side of our group is really to be come into 2023 eyes wide open.
Right.
What we think is going to be a new normal of investing, where it's not just going to be one dominant asset class, U.S. large cap equities that are going to be driving returns. The reason why diversification is going to be so important is that you're going to be getting contributions from small, medium, fixed income places, international places where maybe had less of a contribution in years past.
I think that was well said. We wish everybody a happy new year.